Welcome to The Explainer. Today we're unpacking a strictly data-driven blueprint. Absolutely no hype, no hot stock tips, and definitely no secret insider knowledge here. We are talking about pure, relentless math. We're looking at a strategy using 5 specific index funds that could literally make you a millionaire by the year 2040. That is just 14 years away, so let's break down exactly how these numbers actually work.
$1 million. It's a massive, kind of intimidating number, isn't it? And attaching a firm, concrete deadline of 2040 just makes it feel incredibly immediate. But this is the ultimate, non-negotiable target we're anchoring on today, and we're going to reverse engineer exactly how to hit it.
Okay, let's dive into this, because I know exactly what you're probably thinking right now. Is hitting $1 million in just 14 years actually realistic for a normal person? Well, the data says yes, absolutely. If you start right now, pick the right funds, and stay intensely consistent, the math is entirely in your favor. It doesn't rely on inheritances or some lucky lottery ticket, it relies purely on the magic of compounding.
But before we get to these specific funds, we've got to completely dismantle a massive myth in the investing world, and that's active stock picking. Over literally any 20-year period, roughly 90% of actively managed funds, the ones run by professionals with Harvard MBAs and giant research teams, actually underperform a simple, passive index fund. And worse, they charge you 1% to 2% in fees for that underperformance. Meanwhile, index funds charge a tiny fraction, around 0.03%.
And this brilliantly illustrates why that matters so much. That seemingly small 1% fee on a growing $500,000 portfolio, it doesn't just cost you a few bucks here and there. Over 20 years, the difference between paying a 1% active fee and a 0.03% index fee can exceed $200,000 in lost returns. Yeah, 200 grand. That is real wealth just quietly vanishing from your future. Simpler, cheaper, and broader wins every single time.
Which brings us right to our first fund, proudly carrying that ultra-low 0.03% expense ratio VOO, the Vanguard S&P 500 ETF. This is pretty much the gold standard, tracking the 500 largest companies in the U.S. Its 10-year average annual return sits at a very impressive 12.8%. Honestly, if you invested in literally nothing else, this alone is a phenomenal starting point.
Now compare VOO to fund number 2, VTI, the Vanguard Total Stock Market ETF. They share the exact same 0.03% expense ratio, but where VOO holds the top 500 companies, VTI holds over 3,700, so it captures the entire U.S. market, including the mid and small cap stocks. But here's the secret. Historically, their returns have been almost identical, usually within fractions of a percent. The main takeaway here? You don't need both. Just pick one for your core and totally commit to it.
Now, what's really interesting about this slide is the concept of dual compounding. We're bringing in fund number 3, SCHD, the Schwab U.S. Dividend Equity ETF. This fund specifically targets companies with a proven history of not just paying out cash dividends, but actually growing them year after year. Currently yielding around 3.5%, it historically offers lower volatility than pure growth funds. So you basically get 2 engines firing at once, rising share prices and growing dividend income. And that's income you can eventually spend without ever having to sell off your shares.
As absolutely great as those U.S. funds are, the United States represents about 60% of the global market capitalization. Think about that for a second. If you only hold U.S. stocks, you are completely ignoring 40% of the investable companies on the planet. That introduces us to fund number 4, VEA or VXUS. These are international index funds that give you exposure to developed and emerging markets outside the U.S., everywhere from Europe to Japan and India. So, why does capturing that 40% actually matter? Well, because historically, international markets have had extended periods where they just absolutely dominated the U.S. The 1970s and the entire decade following the dot-com crash in the 2000s were times when international stocks were the clear, undeniable winners. Since nobody has a crystal ball to perfectly predict the future, maintaining a 20 to 30% international allocation ensures you aren't betting your entire financial life on just a single country. Our 5th and final fund is a completely different beast, QQQ, the Invesco NASDAQ 100 ETF. Now this one is heavily weighted toward giant tech companies, but it comes with a massive warning label. QQQ dropped 33% in 2022. During the dot-com crash in 2000, it plummeted nearly 50%. Let me put that into perspective. If you put $100,000 into QQQ in January 2000, you wouldn't have broken even until 2012. 12 years. So yeah,
This fund requires some serious psychological fortitude.
But here is the reward for surviving all that crazy volatility. An extraordinary 10-year average annual return of roughly 18%. That is the highest of any mainstream index fund we're discussing today. But because of those massive historical drops, the strategy heavily suggests using QQQ strictly as a 10 to 20% portfolio tilt, never, ever as your sole holding. It's essentially a high upside booster for investors with a really long horizon who absolutely won't panic sell when things get bumpy.
Let's move to and see how this builds into a highly actionable strategy. Here is the blended core portfolio blueprint all put together. 60% goes into VOO or VTI as your primary U.S. growth engine. 20% goes into SCHD for that dual compounding stability we talked about. And the final 20% into VEA or VXUS for your international diversification. What you end up with is a remarkably balanced global portfolio with average fees of under 0.05%.
So what does this actually cost you out of pocket per month to reach that $1 million finish line by 2040? Assuming our blended 3-fund portfolio gives you a historical 10 to 12% average return, you're going to need to invest between $1,400 and $1,700 every single month starting today. And that's assuming you're starting from absolute zero. But hey, even if you can't hit that number right now, starting with something like $500 and increasing it with every pay raise keeps you moving toward the exact same target. The math simply rewards your time in the market.
So the crucial point is really about mindset over math. The data reveals one golden rule to actually pulling this off. Automate, stay, and don't touch. Automate your investments on payday before you even have a chance to see the cash. Stay in the market through every terrifying headline, treating market drops as basically just sales on your future wealth. And whatever you do, do not panic sell. There are no hot tips here, folks. The boring path is for sure the winning path.
To turn this explainer into reality, here is your exact 4-step action plan to execute this week. Step 1. Decide on your simple fund combo. Step 2. Open an account, like a Roth IRA. Seriously, platforms like Fidelity take maybe 15 minutes online and have zero minimums. Step 3. Set up that automatic monthly contribution. A consistent $100 a month will always beat a one-time $1,000 investment. And finally, Step 4. Find a portfolio tracker to map your progress. Just watching that 2040 date get closer and closer is going to keep you incredibly motivated.
The math is completely proven, and these index funds are easily accessible to absolutely everyone. So the only real variable left in the whole equation is you. I want to leave you with this final provocative thought. Do you actually have the discipline to choose the boring, winning path and just let time do the heavy lifting? Think about it. Thanks for learning with us today on this explainer, and as always, keep that curiosity sharp.